Okay, let's just dive right in. Nvidia's latest report is out, and honestly, there's one number in there that is just completely wild.
$65 billion. Sam, is that number even real? That's what they're forecasting for revenue in just the next 3 months. I mean, that's more than a lot of Fortune 500 companies make in a whole year. My gut is just screaming, there's no way this is sustainable. And that really leads to the only question that matters, right? The one everyone's thinking about. Is this it? Are we looking at the peak of some gigantic AI bubble that's about to pop and, take all our money with it? Right, but before we even get into the whole bubble conversation, Alex, we have to look at what they just did. Let's forget the forecast for a minute. The only place to start is with the hard numbers from their latest report. So look at this. Wall Street was already expecting these massive, crazy numbers, about 55 billion in revenue, but Nvidia didn't just meet that. They totally blew past it, posting 57 billion. That's a 62% jump in revenue from the same quarter last year. So you gotta understand, they aren't just growing anymore, they're accelerating at a scale that really shouldn't even be possible for a company this big. And this right here just shows you how absurd it is. They added more than $10 billion in brand new sales in a single quarter. It's kind of like a company the size of a major global airline just appeared out of thin air on their balance sheet in 90 days. That's the kind of growth that literally breaks financial models. Okay, I see the numbers, I do, but I just don't get how. I mean, how is that even possible? Is there really that much demand? And maybe more importantly, how long can that possibly last before everybody who needs a chip has one? And that's the absolute key. And it's where most people get the story wrong. They think about AI chips as this one-time purchase. You train the AI model, which is like building its brain, and then you're done. But the real money, the future money, is in what's called inference. That's the cost of actually using the AI brain, asking it questions, generating stuff. So think of it this way. Training is a one-time construction project. Inference is the electricity bill that runs forever and just keeps getting bigger. And hey, don't just take my word for it. Their own CEO, Jensen Huang, he says this is a self-reinforcing cycle. The more we all use AI, the more inference compute you need. The smarter the AI gets, the more compute it takes to train the next one. It's a loop that just keeps feeding itself. And Nvidia is selling the shovels for both sides of this massive gold rush. Well, what's really fascinating is that Nvidia's growth isn't even being limited by a lack of customers. It's actually being limited by physics. They literally can't get enough of this high-end memory or the advanced packaging from their suppliers like TSMC to meet all the demand. So the whole global supply chain is their bottleneck, which, weirdly enough, means this boom isn't just a sharp peak. It's more like a really high plateau that's going to last for years as they just slowly work through this massive backlog of orders. All right, that's starting to make a little more sense, but I'm still skeptical. It just can't all be good news. What are the downsides here? What are the huge risks that everybody's ignoring because they're just mesmerized by these giant numbers? Okay, here's the first one, and it is a stunner. Historically, China made up about a quarter of their data center revenue, a huge, huge market. But because of US sanctions, that business has just completely collapsed. I mean, last quarter, sales of their special chip for China, the H20, brought in just $50 million. That's not a rounding error. That is a total wipeout.
Wait, hold on. So you're telling me they lost 25% of their biggest business segment and still managed to grow by over 60%? That doesn't add up. Who on earth stepped in to fill a hole that massive?
Entire countries did. We are seeing the rise of what's being called sovereign AI. Nations like the UAE, Saudi Arabia, Japan, they've all realized that having AI infrastructure is now a matter of national security, just like having your own power grid or your own military. So they're spending billions to build their own AI factories. And frankly, they are not price-sensitive customers. They're buying digital independence. But that whole geopolitical story, as big as it is, it kind of hides a much, much trickier risk. It's one that's tangled up in the very fabric of the whole AI startup economy. It's a concept called circular funding. And to put it really simply, it's when a big company, let's just call it Company A, invests a bunch of money into a small startup. And then that startup immediately turns around and uses that exact same money to buy products from, you guessed it, Company A.
And here's exactly how that risk could apply to Nvidia. So step one, Nvidia invests in one of the, say, 170 plus AI startups in its investment portfolio. Step two, that startup, now flush with cash, places a huge order for Nvidia's GPUs. And then step three, Nvidia books that order as pure high-margin revenue. It's kind of like lending your friend money so they can afford to buy your incredibly expensive vintage car. I mean, it looks like a sale, but is the demand actually real? And the potential scale of this is just staggering. Some reports suggest Nvidia has an exposure of over $110 billion through its direct investments and debt that's backed by its own GPUs. Now, let me be really clear, this doesn't mean the revenue is fake, but it definitely raises some serious questions about how much of the demand is truly organic versus how much is being propped up by Nvidia's own checkbook. Okay, wow, that is a huge red flag. So we've got this unbelievable growth, but also a completely collapsed market in China, and now this circular funding concern. So what does all this mean for the big picture? Is the foundation of this whole thing made of rock, or is it made of sand? Well, while that startup risk is definitely real, you have to look at their core customer base. Over 40% of their sales go to just 4 companies: Microsoft, Amazon, Google, and Meta. And these are not cash-strapped startups, right? These are trillion-dollar giants with mountains of cash who are locked in this desperate arms race for AI dominance. That provides a very, very stable and very real foundation of demand.
And this is exactly how their CEO frames it. He argues this isn't some bubble for a new product. He says it's a fundamental, once-in-a-generation replacement of the entire world's computing infrastructure. We're moving from the old world of general-purpose CPUs to a brand new world of accelerated computing with GPUs. He calls it a trillion-dollar shift, and they're the only company selling all the equipment. So what you're saying is the conclusion here isn't a simple buy or sell. It's that we're watching a company become so central to this massive global tech shift that the old rules of, bubbles and market cycles might not even fully apply anymore. It's almost like Nvidia is writing its own rule book.
Exactly. And that's what leads us to the final and maybe the most critical question. We used to talk about banks being too big to fail because they were so essential to the financial system. Well, now, in an economy that's being completely rebuilt on AI, what happens when the one company that provides the picks, the shovels, and even the gold itself becomes the entire foundation? It's not just about whether a bubble might pop. It's about whether a single company can become too essential to the future to even be allowed to fail.